You've probably seen the terms business loan and line of credit, but you don't really know the difference and no one really explains when to use each one. Most people believe they're basically the same thing. You borrow money, you pay it back, end of story. But the truth is that they actually serve completely different purposes. One is for growth and one is for cash flow. My partners and I have utilized both while building our business here in New York City, and I would say that choosing the right one at the right time will save you thousands in interest and fees. So in this video, I'm gonna break down exactly when you should use a business loan versus a line of credit. I'm gonna explain how each of them works. I'm gonna explain how lenders or banks view them. I'm also gonna help you choose which is the smartest move for your particular situation. A business loan gives you a lump sum of money up front that you pay back over time with interest. A line of credit gives you access to a pool of money that you can draw from whenever you need it. It's kind of like a revolving door of funds. The loan is one-time funding, the credit line is ongoing access. That difference in structure changes how and when you should use each one. Think of a business loan as a sprint. You're borrowing a specific amount of money for a specific project and you want to pay it off as soon as you can. A line of credit is more like oxygen. You tap into it when you need to breathe, but you close it when you don't. A business loan is best for large, one-time expenses that have a clear return on investment. So good examples would be expanding your space, opening up a second location, or launching a new product line, or buying expensive equipment. You know exactly how much money you need, you know how long it's gonna take to pay off, and you also know roughly how much it's gonna help you generate in income. The benefit of a business loan is predictability. You're gonna have fixed payments, fixed terms, and oftentimes lower interest rates. The downside of a business loan is rigidity. And that's because once you take out the loan, now you're locked into this repayment schedule that you have to pay back, whether or not you use all the money or whether or not you start making more money from the investment. And that's why loans work best when you have a specific high-cost project that you know is gonna drive revenue in the future. Use loans to build, not to float. A line of credit is gonna be best for short-term, recurring needs. Things like covering payroll during a slow month, covering seasonal dips in your business, or even managing uneven cash flow month to month. With credit lines, you don't take it all at once. You only take what you need when you need it. So if you have a $50,000 line of credit and you only take out $5,000 to use, you're only paying interest on $5,000. That flexibility is what makes credit lines one of the most useful tools for small businesses. Credit lines are not about growth. They're for stability, safety, and for emergencies. Think of it as a financial safety net. It's there for you when you need it, but otherwise it's invisible. Most small businesses use their credit line multiple times a year to cover temporary dips, but then they pay it back quickly. And if you find yourself using a credit line constantly, that might be a sign that you actually need a loan instead. So the interest structure is where these two products really differentiate. Business loans usually have fixed interest rates, which means that your payments are going to be predictable month to month. Lines of credit usually have variable interest rates, and so they fluctuate with the prime rate. And so that means your payments each month might fluctuate a little bit also. You start paying interest on a loan as soon as you receive it, whereas with a line of credit, you only pay interest when you draw money from it. That's what makes a line of credit cheaper in the short term, but more expensive in the long term if you rely on it too much. Loans are structured like a set plan. There's a very clear start and a very clear finish. Lines of credit are like open tabs, very flexible, but they're very easy to overuse if you're not careful. So to find out which one is right for your particular situation, you're gonna ask yourself 3 questions. Question 1, is this a one-time expense or an ongoing need? If it's a one-time expense, choose the loan. If it's ongoing, choose the line of credit. Question 2, will this investment generate revenue or is it to smooth out cash flow? If it generates revenue and drives growth, use a loan. If it smooths out cash flow and helps with those temporary dips, use a line of credit. Question 3, do you need all the money now or do you just need access to it when you need it? If you need it all up front, take the loan. If you just think you're gonna need money here and there, take the line of credit. Most smart businesses use both a loan and lines of credit. It's not one versus the other, it's about knowing when to use each one. That's how you stay liquid without over leveraging your business. So here's an example from our business. We run a physical therapy business here in New York City, and obviously running a business in New York City is very expensive. Buying equipment, the location, everything. And so we went to Chase, we used Chase for our business loan, and we also used them for a line of credit. And so the business loan that we got at a 10% rate, and the line of credit is at a 14% rate. In my opinion, both those rates are high, but it is what it is. I understand that we're a relatively new business. We've only been in business for 2 years. And so again, that risk is gonna increase our rates a little bit, but yeah. Our small business loan rate is 10% and the line of credit rate is 14%. So the main takeaway from this video is that business loans and lines of credit are both useful tools that you should be using if you're a growing small business. Loans are for growth. Lines of credit are for stability. Loans are going to help you take big swings and hit home runs, but the lines of credit are going to help you survive those slow innings where you're not scoring any runs. So now that you know the difference between business loans and lines of credit, you might be thinking about taking out a business loan. And so check out this video where I talk all about the interest rates associated with small business loans.